Hey everyone, and welcome back to Safe, Simple, Sound Tax Edition. I'm your host, Alex, and this is where we make the often confusing world of finance feel, well, safe, simple, and sound. Thanks for tuning in. Today, we're tackling a topic that pops up every year and can cause a fair bit of head scratching. Understanding how some of the money your money earns itself fits into your tax picture. Specifically, we're diving into interest and dividend income. So, here's how we're going to break it down today. First, we'll start with what is interest income and why does it matter for taxes? We'll define it simply, look at where it usually comes from, think savings accounts, bonds, and really clarify that key difference between taxable and tax-exempt interest. Then we'll move into decoding Form 1099 NT and reporting your interest. This is where we get practical. We'll talk about Form 1099 NT, what those boxes mean, and crucially, discuss reporting income correctly, including when you might need to use Schedule B Form 1040 based on that $1,500 threshold. Next up is diving into dividends, ordinary versus qualified, and Form 1099 DIV. We'll shift focus to dividends, explaining what they are and why understanding the difference between ordinary and qualified dividends is so important for your tax calculation. We'll also walk through the key parts of Form 1099 DIV. And finally, we'll wrap it all up in reporting dividends, Schedule B, and essential tax habits. We'll cover how dividends flow onto your tax return, revisit Schedule B in the context of dividends, and share some vital tips on record keeping and handling slightly less common situations, like income received for others or a child's investment earnings. Our aim is to provide a clear, straightforward guide, helping you understand these common types of income and feel more prepared when it's time to file. Ready to decode your interest and dividends? Let's dive in. Interest income might sound a bit formal, but the concept is actually pretty straightforward. Simply put, interest income is the money you earn for letting someone else use your money. Think about it. When you put money in a savings account, the bank pays you a little extra for the privilege of holding and using your funds. That extra bit? That's interest. So, where does this interest typically come from? Well, there are several common sources. The most obvious one is your bank accounts, savings accounts, sometimes even checking accounts if they offer interest. If you own U.S. savings bonds, the earnings on those are interest. The same goes for investments in government debt like treasury bills, notes, and bonds. You're essentially lending money to the U.S. government and they pay you interest. And maybe less common for some, but definitely relevant. If you personally loan money to someone else and they pay you back with interest, that interest counts too. Now, here's where it gets crucial for your federal income tax return, and it's the core distinction we need to understand. The difference between taxable interest and tax-exempt interest. Taxable interest is, well, exactly what it sounds like. It's interest income that the IRS considers taxable, and you generally need to report it and potentially pay federal income tax on it. This is the most common type. For clear examples of taxable interest, that interest earned on your regular bank savings account? Yep, typically taxable interest. Interest from U.S. Treasury interest tax situations, like those treasury bills or bonds we mentioned, that interest is subject to federal income tax. However, here's a neat little twist. It's usually exempt from state and local income taxes, which can be a nice bonus depending on where you live. Here's one that sometimes surprises people. If you received a tax refund from the IRS and they paid you interest on it because it was delayed, that interest is also considered taxable interest. Then we have tax-exempt interest. This is interest that is not subject to federal income tax. Doesn't mean you never report it. Sometimes you list it on your return for informational purposes, but it doesn't add to your federal taxable income. Some clear examples of tax-exempt interest include interest earned on certain municipal bond interest. These are bonds issued by state or local governments, often to fund public projects like schools or roads. The federal government generally doesn't tax the interest from these bonds. And while we'll talk more about retirement accounts later, the earnings, including interest, inside a Roth IRA grow tax-free and are generally tax-exempt when withdrawn properly in retirement. So thinking about all this, when you think about your own savings and investments, where might you be earning interest income? perhaps without actively thinking about its tax implications. Maybe that old savings bond your grandma gave you, or that high yield savings account you opened. And how does knowing the difference between taxable and tax exempt interest potentially influence where you might choose to save or invest your money in the future? If you're in a higher tax bracket, those tax exempt options might suddenly look more attractive, right? It's all about understanding how different choices impact your bottom line, especially when it comes to interest income tax. And just reflecting back on those examples, what was the most surprising source of taxable interest mentioned? Was it that interest on a tax refund? It catches many people off guard. Okay, so to quickly recap, interest income is money earned from lending your money. It comes from sources like banks, bonds, and loans. The key thing for tax time is knowing whether it's taxable interest, most common, subject to federal tax, or tax-exempt interest, not subject to federal tax. Now for your call to action this week. Take a moment this week to review your accounts. Think savings accounts, any bonds you hold, brokerage statements maybe. Try to identify where you might be earning interest. Jot them down, and based on what we discussed, make a note next to each. Do you think it's taxable or tax exempt? Don't worry about being perfect, just start looking. It's the first step to getting a clearer picture of your financial landscape. All right, now that we've got a handle on what interest income is and the crucial difference between taxable and tax exempt, you might be wondering, how does the IRS know about my interest? And how do I actually report it? Great questions. Next, we'll dive straight into that by decoding the all-important Form 1099 INT and explaining exactly how and when you need to report your interest income on your tax return, including when you might need something called Schedule B. So, first things first, what is Form 1099 INT? Think of it like a year-end report card from any bank, brokerage, or other institution that paid you interest. If they paid you $10 or more in taxable interest during the year, they're generally required to send you this form. They also send a copy to the IRS. That's how the IRS knows what you should be reporting. You'll typically receive these forms by mail or electronically around the end of January, with the official deadline for them to send it being February 15th. So keep an eye out. Now, when you get Form 1099 INT, don't just toss it in the pile. Let's navigate the key boxes. It might look a bit busy, but there are really just a few spots that hold the most important info for most people. Box 1 is usually the big one. This shows your total taxable interest. This is the interest from your regular savings accounts, checking accounts, CDs, etc. Then there's Box 3. This is specifically for interest from U.S. savings bonds, Treasury bills, notes, and bonds. Remember from our last segment, this interest is generally taxable at the federal level, but often exempt from state and local taxes, so it gets its own box. Box 8 is also important. It shows any tax-exempt interest you received. Even though it's not taxed federally, you often still need to report it on your return for informational purposes. You might also see Box 9, which relates to interest subject to the Alternative Minimum Tax, AMT. For most folks, this isn't a major concern, but it's good to know it's there if you have certain types of investments, often related to private activity bonds mentioned in Box 8. See? Not so scary when you know where to look. It's like knowing exactly where to find the price, the item description, and the tax on a store receipt. Okay, here's a crucial point about reporting requirements. The $10 threshold is just for the payer to issue the form. But you, the taxpayer, are required to report all taxable interest you receive on your federal income tax return. Yes, all of it. Even if it's just $5 from that small savings account you forgot about, and you didn't get a Form 1099 INT for it. Why is this so important for accurate tax filing? Because the law says all income is reportable unless specifically excluded, and it ensures you're paying the correct amount of tax. It might seem small, but it all adds up, and being accurate avoids potential headaches with the IRS down the line. Now, where does all this reported interest go? It usually goes directly onto your Form 1040. However, there's a key threshold to know about involving Schedule B of Form 1040, which is titled Interest and Ordinary Dividends. If your total taxable interest income from all sources is more than $1,500, you generally need to fill out and attach Schedule B to your federal income tax return. What does Schedule B do? It basically asks you to list out who paid you the interest and how much you received from each source. Think of it like this. If you only have a little bit of interest, the main tax form is enough. But if you cross that $1,500 line, the IRS wants a more detailed breakdown. So, reflecting on your own situation, does that $1,500 Schedule B threshold seem likely to apply to you this year? It's a good prompt to start tallying things up. And this leads perfectly to our final point, connecting the form to your return. Understanding Form 1099 INT really demystifies the reporting income process. The numbers in those key boxes we talked about, Box 1 and Box 3 for taxable interest, translate directly onto your Form 1040 or onto Schedule B if you need to file it. Box 8, Tax-Exempt Interest, also finds its place on Form 1040. It's designed to flow logically, so when you understand the layout of Form 1099 INT, entering that information feels much less intimidating, doesn't it? It's just a matter of transferring the numbers to the right spots. So let's recap. We've decoded Form 1099 INT. You know who sends it, why, and the key boxes like Box 1, Taxable Interest, Box 3, U.S. Gov Interest, and Box 8, Tax-Exempt Interest. We stressed the absolute importance of reporting all your taxable interest on your federal income tax return, regardless of getting a form. And we introduced Schedule B Form 1040 and its $1,500 threshold for itemizing your interest sources, showing how it all connects for reporting income. Now for a little homework, your call to action. When you receive your Form 1099 INT this year, or grab last year's if you have it handy, take a moment to locate Boxes 1, 3, and 8. Add up all your taxable interest from Box 1 and Box 3, plus any you didn't get a form for. Does that total cross the $1,500 mark? Knowing this early helps you anticipate whether you'll need to prepare Schedule B when you file. Taking these small steps makes tax time feel much more manageable. Now that we've tackled interest income reporting, what about income from stocks? In our next segment, we'll dive into the world of dividends, ordinary versus qualified, and the form you'll likely see for those, Form 1099 DIV. First things first, what exactly is a dividend? Think of it like this. When you own stock in a company, you own a tiny piece of that company. If the company does well and makes a profit, it might decide to share some of those earnings directly with its owners, the shareholders. That payout, that sharing of the profits, is a dividend. It's a way for companies to return value to the people who've invested in them. Sounds pretty good, right? Earning money just by holding an investment. But as with most things financial, the tax man, Uncle Sam, wants to know about it. And this is where things get interesting, because not all dividends are created equal when it comes to your dividend income tax. This brings us to our crucial classification: ordinary dividends versus qualified dividends. It's really important to understand this distinction because it directly impacts how much tax you might owe on that dividend income. Let's break it down. Ordinary dividends are, well, the more common type, and they're generally taxed at your regular income tax rate. Think of it like adding that dividend income on top of your salary or other earnings. It gets taxed in the same bracket. But then we have qualified dividends. These are special. To be qualified, the dividends need to meet certain requirements set by the IRS. Things like how long you held the stock and the type of company paying the dividend. Why jump through these hoops? Because qualified dividends get preferential treatment. They are taxed at the lower long-term capital gains tax rates, which are often significantly lower than regular income tax rates for most people. Imagine getting two types of bonus checks from work. One is treated just like your regular pay and taxed accordingly. The other gets a special lower tax rate applied. That's kind of like the difference between ordinary dividends and qualified dividends. Identifying which is which can make a real difference to your bottom line. This is exactly why identifying whether your dividends are qualified is so important. Lower tax rates mean you keep more of that investment income. Now, how do you know which type of dividends you received and how much? Just like interest income has its dedicated form, so does dividend income. Say hello to Form 1099 dividends and distributions. If you receive $10 more in dividends from a single payer, like your brokerage firm where you hold your stocks or mutual funds, or sometimes directly from a company, you should receive a Form 1099 div early in the year, typically by mid-February, just like the 1099 INT. Let's peek inside this form because understanding a few key boxes makes things much clearer. First up is Box 1A, Total Ordinary Dividends. This shows the total amount of ordinary dividends you received. Remember, this is the portion generally taxed at your regular income rate. Right below it, you'll find Box 1B, Qualified Dividends. Now, this is crucial. Box 1B shows how much of the total amount listed in Box 1A is actually considered qualified dividends. So the amount in 1B is part of the amount in 1A, but it's the portion that potentially gets that favorable lower tax rate. Seeing both these numbers side by side on Form 1099 Div instantly helps clarify your potential tax situation. You see the total, and then the slice of that total that might be taxed less. Then take a look down at Box 12, Exempt Interest Dividends. Does that term exempt interest ring a bell? It should. We talked about tax-exempt interest back in Segment 1, often from municipal bonds. Sometimes if you own a mutual fund that holds these types of bonds, the interest it earns and passes through to you as a dividend is still tax-exempt at the federal level. Box 12 is where you'll find these amounts reported. It's a great example of how concepts connect. The tax-exempt nature flows through the fund to your Form 1099 DIV. And briefly, keep an eye on Box 13. This might show exempt interest dividends that could be subject to the Alternative Minimum Tax, or AMT. We won't dive deep into AMT today, but it's good to know that Box provides specific information if it applies to you. So, to recap this segment, dividends are payouts from company earnings to shareholders. They primarily fall into two tax categories: ordinary dividends, taxed at regular rates, and qualified dividends, taxed at lower capital gains rates. You'll find all this information neatly summarized on Form 1099 Div, particularly in Boxes 1A and 1B, which clearly separate the total ordinary from the qualified portion, and Box 12, which flags any tax-exempt dividends. Now for your action step this week. If you have investments in stocks or mutual funds, take a look at your recent brokerage account statements online, or be ready when that Form 1099 DIV arrives in the mail or electronically. Specifically, look for the amounts listed as total ordinary dividends and qualified dividends. Just seeing those numbers and knowing the difference in how they might be taxed is a huge step towards understanding your overall dividend income tax picture. Understanding what these dividend types are and where to find them on the form is step 1. Next up, we'll talk about how you actually report this dividend income on your tax return, revisit the role of Schedule B, and share some essential habits to make tracking all this investment income, both interest and dividends, much, much easier year-round. So, you've got your Form 1099 Div in hand. Now what? That's exactly what we're diving into in this segment. We'll talk about how to actually report that dividend income on your federal income tax return. Revisit our friend's Schedule B Form 1040, hammer home the absolute power of good record keeping, touch on a couple of special scenarios, and then wrap it all up with some key takeaways. Ready? Let's get practical. First up, getting that dividend info onto your tax return. Your Form 1099 DV basically gives you the numbers you need. That Box 1A, the total ordinary dividends, that generally gets reported right on your main Form 1040 tax return. And Box 1B, those important qualified dividends. Remember, those are often taxed at lower capital gains rates, so there's usually a specific line or maybe a calculation worksheet where those get entered to make sure you get that potential tax benefit. Think of the Form 1099 DIV as the answer key provided by your brokerage or company, and your tax return is the test. You just need to carefully copy the answers into the right spots. Now, remember Schedule B Form 1040? We talked about it back when we discussed interest income, mentioning you usually need to fill it out if your total taxable interest income is over a certain threshold, often $1,500. Well, dividends play a role here too. The requirement to file Schedule B is often based on your total taxable interest and ordinary dividend income combined. So, if your combined total from both sources pushes you over that threshold, you'll likely need to attach Schedule B to your federal income tax return. On it, you'll list out each source, who paid you the interest and who paid you the dividends. It's simply the IRS's way of asking for a bit more detail. Kind of like showing your work in math class once your investment income reaches a certain level. Okay, let's talk about something absolutely crucial, maybe the most crucial point for maintaining your sanity year-round: record keeping. I know, it doesn't sound glamorous, but please trust me on this one. Trying to piece together your income picture during the stress of tax season is like trying to find a specific Lego brick in a giant bin while blindfolded. Incredibly frustrating, and you're likely to miss something. The power of good record keeping cannot be overstated. This means, at a minimum, saving those Forms 1099 INT and, absolutely, your Form 1099 DIV when they arrive. But ideally, it also means having a simple system to track all your interest and dividend sources and the amounts you receive throughout the year. Maybe, when you get a bank or brokerage statement, you quickly jot down the interest or dividend amount. Maybe you update a simple spreadsheet once a quarter. Just pause and think about this for a second. What simple system could you implement today, like right after listening to this podcast, to make tracking your interest and dividend income significantly easier for next year's tax filing? Could it be a dedicated folder on your computer, a specific labeled physical folder, a basic spreadsheet template? Whatever works for you, make it easy for future you. Future you will thank you, believe me. Now, very quickly, let's touch on a couple of special situations you might encounter. Sometimes you might receive dividend or interest income as a nominee. This means the account is legally in your name, but the money actually belongs to someone else. Maybe you're holding an account for a child or another family member. In this case, you generally report the full amount shown on the 1099 on your Schedule B, but then you subtract the portion that belongs to the actual owner, showing it clearly as a nominee distribution. It ensures the income gets taxed to the right person. Another area is if you have children who have their own savings or investment accounts that are earning interest or dividends. Be aware there are specific rules around their unearned investment income tax, often called the kiddie tax. Depending on the amount of investment income the child earns, it might be taxed at the parent's higher tax rate using Form 86115. In some situations, parents might have the option to elect to include their child's interest and dividends directly on their own tax return using Form 884. It's definitely something to look into or ask a tax pro about if your kids have their own investment income streams. So, here's a moment for reflection. If you have children with savings or investment accounts, how might these rules around their unearned income potentially affect your family's tax preparation process, either this year or as those accounts grow? It's worth being aware of. All right, let's bring this all together. We've navigated through reporting dividends, the purpose of Schedule B for both interest and dividends, the vital importance of record keeping, and those quick mentions of nominee situations and children's investment income tax. We've seen how interest and dividends differ, mainly in how they're generated, but share similarities in reporting, like using Forms 1099 and potentially needing Schedule B. Thinking about everything we've covered today regarding both interest income tax and dividend income tax, what is the single most important takeaway for you personally that makes you feel a little more confident heading into tax season? Is it finally understanding what Form 1099 DIV is telling you? Recognizing the trigger for Schedule B? Or perhaps just the simple, powerful idea of getting organized before tax time? Whatever your key insight is, hold on to that feeling. And please remember, while we strive to make finance safe, simple, and sound here, this podcast provides general information, not personalized tax advice. For the definitive rules and guidance tailored to your unique situation, always consult the official IRS resources. IRS Publication 17 is a great comprehensive guide, or speak with a qualified tax professional. They can help ensure you're applying these rules correctly, especially for anything complex. Okay, before we wrap up this segment, here is your concrete call to action. I genuinely encourage you to do this, maybe even this week. Set up us a system now. Don't wait until next January. Create that simple spreadsheet or grab that dedicated folder, physical or digital, where you can consistently track your interest income tax documentation and details and your dividend income tax documentation and details throughout the year. File away those 1099s as soon as they arrive. Maybe make a quick note of income from your monthly statements. This proactive step is one of the best gifts you can give yourself to make tax time much, much smoother. Phew. We made it through the weeds of reporting interest and dividends. Hopefully, decoding this part of your federal income tax return feels a lot less intimidating now. All right, folks, that wraps up our deep dive into decoding interest and dividend income for tax time. We covered a lot today, starting with the basics of what interest income is and why distinguishing between taxable interest and tax-exempt interest is so fundamental. We then navigated those crucial tax forms, Form 1099 INT for interest and Form 1099 DIV for dividends, breaking down what key boxes mean and how they help you with reporting income accurately. Remember, knowing whether your dividends are qualified dividends can make a real difference to your dividend income tax because of those potentially lower rates. And we clarified that $1,500 threshold that often triggers the need for Schedule B Form 1040 for both interest and dividends. The goal, as always, was to take something that can feel complicated, understanding your investment income tax obligations, and make it feel more manageable, more, well, safe, simple, and sound. Hopefully, you now feel a bit more confident about tackling this part of your federal income tax return. Just knowing how to read those forms and where the numbers generally go can reduce a lot of that tax season anxiety. Thank you so much for tuning in and spending this time with us at Safe Simple Sound. Your financial journey matters, and we appreciate you making us a part of it. Until next time, keep asking questions, keep learning, and keep making those sound financial choices. This is Alex, signing off.